All right. So we are back for another episode here. And really, I think that the theme for me and probably a lot of people is the market's hitting these all-time highs. We had FOMC last week. This was the FOMC day, Wednesday, this big dip down, and then it's kind of been off to the races. So there's a little bit of a head fake there. And then the market kind of went to new highs. So kind of just wanted to talk a little bit about a couple of decisions that I had to make last week, which were do I stay fully long, or do I kind of reduce my risk and see if we get a pullback or not? I ended up reducing my risk a little bit. And I can kind of share how I did that. But Brian, I wanted to kind of get your take on, with the market closing at those new highs last week. Did you make any like position changes, or, are you factoring this in at all, or are you just riding the trend for now?
Well, you know what I did going into the Fed meeting was to take off stuff that was pretty close to my profit targets. So I know, like for some of my SPX trades, if I'm shooting for 50% and I'm at 40%, I took those off before the meeting. But not really like I'm going all cash.
Right.
But and I didn't really put on anything in anticipation of the FOMC. I think everybody knew it was going to be 0.25%, and then all the drama was going to be, well, what does Jerome Powell say, presser, and that's actually what happened, right? It just the longer he talked, the more the market dropped, and then I think it takes a day or two for the people to kind of digest all that information, and it seemed like, okay, then we're good with it. We're back into the bullish trend, but
Yeah, it's interesting because that one, in that one day, we actually did get a pullback, and then
yeah.
we took off. So it's like, well, we did get a pullback.
Yep.
It was just, 2 hours long or whatever,
Yeah, I've always heard, someone had told me, is one of the things that when they have these kind of moves, the first move is usually wrong. And that's kind of what I always think about. So when it pulled back, it was like, okay, I hope that's wrong, because then we can go up again. So
Yeah, I was leaning towards up because we follow a lot of, for the lack of a better term, some trend following stuff, and we try to, for my SPX trades, we try to get as many trades in as possible, and when we have these bull runs, so we can kind of leverage to the upside, but kind of in a controlled way. And this dip was kind of weird because even though we did recover, we still closed below the day before. So it was kind of, it was dicey. And then
yeah,
even the next day we broke out, and then it kind of came back in. So
yeah,
Wednesday, Thursday was pretty dicey. It was hard to, I guess, get, add to longs, that type of thing. But yeah. So one of the things I wanted to just kind of share here, you see these green lines on my chart. These are from spotgamma.com, and these are like the major option levels, and they do fluctuate over time. So these aren't like hard support resistance, but it does give you an idea of, where would the nearest maybe support and resistance be. And typically we're in an uptrend. The call wall is up here right now at 6,700. I think it was at 6,750 last week, which was down here. So the call wall, technically rolled up, and that just means that's where the largest gamma position for calls is right here. And, we still have a big level at 6,650. The vol trigger is an interesting level for them. And again, this changes. Every day this can update and fluctuate a little bit, but the vol trigger is basically if, and I'm sure SpotGamma has a better definition on their website, but it's basically, the way I read it is, if the market's trading above the vol trigger or volatility trigger, the market is a little bit more supported. And right now that vol trigger level is at 66.20. We're trading at 66.75. So even a minor pullback to a few moving averages, and if we were to consolidate here, would still be, in the bullish realm. And if we rally straight up into the call wall, I would expect that resistance to maybe hold a little bit. But on Friday, I don't think the call wall was at 6,700. I think we had a level in here. So what I ended up doing to kind of reduce my risk was I was in some put credit spreads that expired today and tomorrow, and I was at 50% of the profit on those. And the backtest model that those are based off of, typically we hold to expiration or hold longer. But I didn't want, it was one of those things I was like, okay, yes, we rallied, but, last week we also had triple witching, which was kind of added to the chop, if you will. So it wasn't really clear that we were going to keep going higher. Obviously, in hindsight, holding my longs would have been better. But we don't always have that luxury. We did open up down today, but we are, pushing to new highs now.
Yeah.
Pretty interesting. So I got one question, Don. Do the weekly alpha crunching trades take into consideration the pullback notions you are discussing? No, they don't, Don. Alpha crunching is strictly based on the closing price of SPX on various time frames, open to close, 1 week later, 1 day later. So one of the, and let me back up. And so what we try to do is with alpha crunching is trade kind of more mechanically, if you will. And when I've talked to other mechanical traders who do more auto trading, there's really some of the guys in the futures markets that are doing more high frequency stuff. But what they tend to do, and I did a thing on the podcast a while back with the guy from Traders Post. I can't remember his name right now. I'll see if I can find that episode. But I asked him the same question, like, hey, when the market's really bullish and you have the big event, and what do you do? And his response was, for the most part, he follows the system. He might reduce his size, but he may introduce some discretionary hedges. And so that was kind of my mindset last week was, I don't want to necessarily close up shop and, like you said, Brian, go straight to cash. So I wanted a little bit of exposure. I know that I was going to be adding new trades this week. On the alpha crunching board, there's a bunch of PCS trades that are on the board this week for Monday, Tuesday, Wednesday. So I knew I was going to be adding longs as early as today.
Right.
So it was like, okay, I'm going to be adding longs next week. So I chose to take profits early, and I actually skipped the trade on Friday. I skipped Friday's trade because I thought there was a decent chance we'd get a little bit more of a pullback after OPEX, and that apparently was wrong. So I didn't fully trade the mechanical strategy to the T, but at the same time, I slept pretty well this weekend. So, that's kind of the trade-off you have to kind of consider with that. So I got a question for you, Brian. He said he never got an answer. He's new and he would like to know how to pick and trade off of Brian's weekend watch list. So why don't we, maybe you can share the screen.
Yeah.
You can share your watch list, and we can talk about some of the trades you're looking at for this week. And then we'll talk about some of my other trades I'm looking at this week as well.
Yeah. So happy to do that. You want me to share?
Yeah. Can you?
I think I'll have to send you a request.
Yep.
I think you have to stop sharing or something.
Do I?
Oh, no, you're good. So
Good. Okay.
Okay. So for those that are in the Alpha Trading Club, I produce a watch list every weekend, and I do a couple of or 3 different strategies. I may be adding a 4th one, but the first one is my in the money covered call strategy, and that's kind of one that we've gone back to I've been doing for a long time, and it incorporates some dividend captures as well. So in that particular one, I'll list out the stock name, and then this is just a Google feed as the current price, and this is what the price was when I did the watch list. This will be Friday's close in most cases. So let's just take the first one across, and I'll just walk through everything and answer any questions. So at the time that I put this together, Etsy was trading for $64.99. And the trade would have been to sell the 60 call, buy the stock at $64.99, sell the 60 call. And this trade at the time was $5 in the money. And then I look at the option chain and say, well, what is the expected move for that particular stock in that? So it was a 4.5 expected move. And the credit that I would get for selling the 60 call expiring on 10/3 was $5.90, which would, so the net credit is $91 per 100 shares. And you get that number by basically seeing how far you're in the money, less the credit gives you your net credit, because we're buying an in the money covered call. So most of that $5.90 we won't capture. That's our downside protection. And then I just list how much capital is required for 100 shares. So in this particular one, if you set this up, it would have cost you $5,900, which was a 1.5% return in 11 days. Now the downside protection was 9.8%, 9.08, so 9.1, meaning that from $64.99 all the way down to $60, the trade still makes a full profit. And the break even where it starts to lose money would be down here at $59.09. So that's kind of the way that I set up the thing. And if there's a dividend, I will put down here when it goes ex-dividend, what the dividend is, and then the chart just adds that dividend in. So, and then it annualizes the rate of return as well. Any questions on that? And then I can walk to the other ones if.
No, yeah, I don't really have a question. I guess it's more of a comment. I was thinking, I think you cleared it up for me. One thing I had a kind of hard time understanding, and I end up using the risk graph to answer my questions on this, but understanding the actual credit and you get that unlike selling it out of the money option, you're not going to have it expire worthless where you get to keep the entire credit. In which case you're looking to keep a portion of the credit, but the probability is actually really high still because, like you said, the expected move is 450 and you're $5 in the money. Like you said, was that 8 or 9%?
Right.
I mean, the stock really's got a tank in the next, whatever it is, 2 weeks.
Yeah. So even if it dropped all the way down to $59 from 64, it's a break-even trade. So
right.
So that's pretty. That's the beauty in the trade. And it's not sexy or really exciting, but it's an income driven. And this would not be. This is a strategy where you don't plan on keeping the stock. So, and I go through the weekend and I kind of identify ones that I think make sense. Then I run the numbers and I generally sort them by how much downside protection. So if my goal is I want to get 5% downside protection and a 24% annualized rate of return. That's kind of what I shoot for all the time.
Yeah, and that's just asking what the criteria to enter and exit this trade would be. Is there a time of day or day of week? Is there any sort of is there any final trigger to get in that trade other than?
I mean, what I would say, like today, it looks like Etsy is pulled back a little bit. So you'd have to rerun the numbers to enter it. But if it's in a sector that I like, and particularly around a dividend, if it's around a dividend, you definitely have to be in the trade 1 day prior to the ex-dividend date.
So that's one trigger that you definitely don't want to miss. And then, just looking for, is it look like it's moving up, then, and it's on the list, then I kind of rerun my numbers based on the current stuff and see if it still meets the criteria. And if it does, then I just jump in and do the trade.
Okay. Yeah. So there's no, or for lack of a better term, technical analysis entry. It's more you've already done the homework up front. And in order for it to make this list, it already has to be in a relatively bullish mode, right? It's already above some moving averages. I know you've talked about that before. So really at this point, you're just kind of confirming that your criteria is met before entry.
Yeah. So on Sunday afternoon, I'm looking at, these all are in bullish patterns, they're in good sectors, the numbers, line up. Once the bell rings, it could change. So you definitely want to rerun, the numbers.
Yeah. And last question about this was what the exit?
So what I will do is almost all of the time, I just let it expire. And so, for example, on Etsy, I've got the 60 call. I don't actually have this trade, but this was on the watch list. As long as the stock is above 61 or 60 on next Friday, it will generate a 1.5% return, 59% or 51% annualized, and it will just expire worthless. Now you can close it early. And what I would just say is calculate what your return and what your annualized return is to see if it makes sense, say, to close it in a week. If it makes, if you can make a 75% annualized return in the first week, I would take that profit and then, put another trade on, reuse that capital.
Yeah. Yeah. I would need to watch one of those because, when you think about selling a call, if the market, or let's say Etsy were to go down, and let's say it drops 2% over the next couple of days, the volatility and the stock's going to go up, but the call's going to be not as far in the money. So do you see like minor pullbacks? Are those profit taking opportunities for the position, or does it kind of, you still got to wait around long?
I think what you just have to kind of calculate what's my net profit if I leave early, and then from there calculate what's the return. And
like you're losing in the stock itself.
There's one's going to go up, one's going to go down. Like we had one,
probably got to hold it, I'm guessing, longer.
I generally just plan on holding them. But just as a really weird example, last week in the group, I put a trade on in Rocket Lab, RKLB. I bought the stock. The stock is down 7% from where I bought it, and it's still $2, almost $3 in the money. So that's the kind of, the appeal of this kind of a strategy is just an income strategy, and it can take some heat without you losing money on a trade.
Yeah.
And then, so I hope that helps. And then I'll just go over the poor man cover call, because this is one we're going to talk about tomorrow night in our option group, and everybody is welcome to join. We have it online. But this one is kind of the same thing. These are trades that I will do it via a diagonal call. So I just did a trade on BABA on this one, the stock price is at 162.81. So I would be buying a 160 call, slightly in the money. Here's the expiration. I think I actually used 1031. And then here's the debit. So the cost of buying this particular option is $9.80, or was at the time. And it's a 59 delta. And then the second thing I do is I will sell a call, just like we would a covered call. So I bought the 160, and then I'm selling a call against it for a credit of 195. So my net cost per contract is $785. So if the stock moves from 160 to 170, that's a $10 move. And I just take this $10 times my delta, and that would say we would expect a $5.90 gain on our long call. And so that would be like a 60% return. It doesn't really take into consideration the short call because it's just I couldn't figure out how to calculate the rate of return. So theoretically, if it finished right at 170, we would, in addition to the 590, you would get the $1.95.
Right.
So and I generally look to get like a 30 to 50% profit on these poor man cover calls, and I will continue to roll these out for a while to collect additional credit. So that's the poor man cover call. So I know I went through that fast, but that's and I put that out for the group every Sunday night.
Yeah. All right. Very cool.
Good. Okay. Oh, and then the butterfly. I'll do the butterflies. So this on a butterfly, I have my list of stocks, and then this is the price where it was Friday's close. So if we were doing like A lab, the price was $245. The trade would be to buy one 250 call, sell two of the 280s, and then buy one of the 300. Now these are considered what they call broken wing butterflies, meaning that the distance between the long call and the short call is not symmetrical. Meaning that, so if this stock went through my 300 call, the trade couldn't lose money. If it was a regular butterfly, it could. And so this setup, as it was on Sunday night, would have cost $5.10. $510 was the maximum risk. And if the stock moved right up to 280 at expiration, it would net like a $2,400 or $2,490 profit. So it's a 4.88 reward to risk. So that's the
yeah, very nice.
So they're high reward, and the odds of nailing it right at 280 are pretty minimal. But so we're looking, if we can get a 50% return on the trade, perfect. If we can't, then we generally will try to take it off at 50%. So I
like to it. Yeah. And one thing that it's interesting, because I know when you deal with short calls on stocks and ETFs, you are, there's that slight risk of early assignment.
Mm-hmm.
But what I'm seeing here is with the price of ALAB at 245,
mm-hmm.
and you're buying like an out of the money butterfly,
slightly out of the money. Yeah.
So those right calls, the one you would actually, be, worried about. So the stock would have to go up $35 in, would you have October 7th, let's call it 3 weeks, 4 weeks.
Mm-hmm.
That would be like I don't know, 10%. That's a big gain.
It is a big gain, and this is a mover, so
percent.
Mm-hmm.
So you're really not at risk. So if it were to blow up into 280, I know I would be like, I would take the profit, and I'm sure you'd be.
Yeah, and and if we got to 280, my 250 long call is looking really sweet. So
yeah. Anesha asked about, do you use a stop on the butterfly trades?
I do. I would do the same thing, like an 8% from the stock price.
He's working up there today, so I wanted to go.
What do you mean 8%?
Like where I bought the stock at, I will exit the trade if it drops more than 8%. So like on ALAB, if it's $245, I would get out on an 8% drop.
So you're not basing the stop on the debit of the.
No, I'm looking more at the price of the stock
Okay.
But if it gets to 280, I'm getting out and grabbing my profit.
Yeah. So you're essentially risking the whole thing if
Yeah, and
probably get out sooner, but if you're, if it's just chopping around there to say it's just stuck at 250, that butterfly is going to decay.
it will. All right. Yeah.
Because they're out of the money.
Right. This trade makes money if it moves, between your long call to your two short calls. Remember, you're selling two short calls for every one long, your first long call.
Right. Okay, so yeah, so you're looking more at the stock price as opposed to the
I do, yeah.
price for that one. Okay. Okay. Well, cool. Yeah, thanks for sharing.
Yeah, I hope that helped.
Yeah, yeah. I'm gonna go back and get your opinion on I'm gonna switch over to SPY. I talked about this a while back. Man, the market is just all out today.
It is
insane.
I had a good weekend.
Yeah. So I mentioned, I think it was a couple weeks ago, I was in and out of SPY shares themselves, and I was doing some covered call, and I had bought more than 100 shares because when I sold this covered call, this was September 19th, which was last week. I knew that, well, if the market broke to new highs, I wanted to participate. However, if it rolled over, then I'd have some protection here. So the market ended up breaking out. So I had 100 shares called away from me last week at 647. That's the price that I sold. I sold those at. I had been legging in here, so it was a profitable trade. And now I'm in, I think it's 50 shares or so. And now I'm kind of in this position of like, well, what do I do now? It's like, do I buy more shares here, sell a covered call? I'm kind of in the camp of waiting for a pullback kind of thing. But I'm also, the other thing I could do, and let me bring this up, is if I go out to the October expiration, and let me go back here. So let's just call this like the breakout area, loosely call it, 650. So I could sell a naked put. Where is it? If I go out 25 days, I could sell a naked put here and get $3-4 for it, $400, but I'd have to wait. So do you have any ideas here on getting more exposure here or waiting? What's your thought on this type of trade?
Yeah, I mean, I personally wouldn't be just buy 50 shares at this level. I would wait for the pullback, and so that'd be my thing. Is it's not worth buying it at these levels, and I mean, it could keep going higher, but it's a lower probability at if you had some kind of a pullback. So I'd probably look at it on like a 15-minute chart or an hour chart, and if there was a pullback, particularly to something like the VWAP level, then I'd be all in it.
Yeah, and I was thinking about the in the money covered call, because I could I don't know what the my basis is, but if I bought 50 shares right here, and then I could sell an in the money call, and that way I'm at least protected down to that point. But at that point I would be capping my.
You would be. What you could almost do there is like do an at the money, or just like a couple strikes higher. That would be, still give you a great credit without, like, oh, I bought in it. But
I don't feel like that's enough protection.
It's not protection
as much.
Yeah, I mean, it's kind of like, if you want the protection, the in the money is your best option. If you want income, you want to go further out. So it's
so if I bought the 50 shares, I could sell an at the money call spread or call for 900 or $1,000, and then I would have $1,000 of protection. I'd have to do the math on how much.
Yeah, it's a $10 drop, right?
Yeah.
So
55. No, okay,
pretty good.
But then I can't. But if it goes higher, I'm not gonna.
You'll make $1,000.
Yeah. Yeah. So I think I'm just going to wait.
Yeah.
And
Yeah, it's tough when it's like so overbought that it's like you gotta wait. You can't jump in.
Yeah. Yeah. And I think a lot of people, you're either, I don't think I know anyone who's fully invested ever, like all the time, from like a trading perspective. Obviously, if you're doing 401ks and things, that's a different kind of thing than what we're talking about. From a trading perspective, I always have something on the sidelines for the next trade.
Yeah.
And then I do want to talk about Intel. I brought this up a while back. I had bought some Intel shares in this zone here. Right around here, I bought it for 25. Remember, I bought a starter position. Well, lo and behold, I got lucky, and NVIDIA is investing in the U.S. government bought into them, or some I forget the headline or whatever it was. I was like, okay, well, I'll buy a starter position, and then we'll see how that goes. And then I think NVIDIA is doing some kind of investment with them, and they popped like 20-30% on this day. And luckily, I did not sell any covered calls on it yet because I wasn't really in a full position. So I didn't really want to hedge it. I had an order down here at $20 to buy more if it was going to be range bound, but it broke up and now it's pulling back. And I think now I'm just going to hold I forget how many shares it is. I'm just going to hold the shares because it was kind of a small position. I looked at a covered call and I think I could get $60 for one of them. And I was like, I don't even want to mess with it. I don't, it's too low priced of a stock to try to sell one covered call, like $60 over the next 3 weeks or whatever it is. So I'm just going to hold it.
Yeah. I mean, I think that pullback is just pure profit taking.
Yeah.
And you should see it move, kind of resume its path once, the profit takers are out.
Yeah, I was thinking about, maybe selling some puts down here to see if it actually came back in. I could buy more here.
Yeah.
So I may tinker around with that.
That's probably not a bad idea.
Sure, but this is the difference between trading shares and options. Is your timing doesn't need to be as accurate. You don't have to worry about expirations. I could have bought leaps on Intel. I probably would have made a bunch of money on that, but I didn't know it was gonna do a 30%. Stock one day.
You didn't predict that.
No, and it wasn't even earnings.
Yeah, no, it was just a news.
We have earnings here, so I'll probably just end up holding my current shares through earnings, and if it goes lower, I'll just start over, kind of thing. I'll just buy more, whatever.
Yeah.
But anyway, that happened last week. That was fun.
Yeah, that was an interesting move.
Yeah, what was that? That was Thursday. Yeah, it was like the day after FOMC. So I was pretty sidetracked. I woke up and was like, "Oh, okay. I'm gonna have a good day no matter what FOMC."
I'm really smart.
Yeah. We'll open it up to any questions. You guys have anything else you guys want us to cover before we wrap up? No one's asking you, Brian, what's your favorite chart indicator?
I'd like to look at, I like the moving averages to be on there. I like the 20, 50, 100. I also look at the RSI, and I also have Bollinger Bands. I set them up at like a 2 and a 3, I guess standard deviation. And I like money flow as well. So
nice. All right. Well, do you have any other trades you want to share? I got one more I was going to kind of wrap up with, or...
No, go ahead.
Okay. So one of the alpha crunching trades, the reason I'm probably bringing it up today is because last week's trade actually hit its profit target today. So last Thursday, I sold a September 25th. That's 7 days to expiration. So it expires this week. I sold the 6640. Mouse is freezing up here. So the 6640, 6635 put credit spread. I think I got about $2 for that. And this is one of the alpha crunching trades on the trade ideas tab. This is one of the put credit spread trades here. And this trade has been doing pretty well over the last couple years. It's entered on Thursday if the weekly triumph rate is above 50%, which all of them are right now. So we still kind of look at the moving averages, and those are the moving averages I had on the chart there. Just a quick look at the kind of look back over the past, let me zoom in a little bit, over the past couple of years. This is as of August. It's running an 87% win rate. This is a Thursday trade by selling that at the money put credit spread. And the expectancy is a little bit lower at $57, but that's because we are taking profits at 50%. So if you sell a trade or sell a credit for $2 and you're always taking profits at 50% or so, you're not going to be able to, achieve the full, achieve the full credit, right? Or full profit, max gains. But part of this strategy is, or all these strategies are really finding the right win rate with the capture rate so that you can be profitable over time. And this is one of the ones that actually did better with that 50% profit target. A lot of the other ones do better with just letting it go to expiration. But I wanted to just highlight that trade. This week is coming up on Thursday. The one from last week hit profit today. And I'm still holding a call credit spread hedge from last week down here at 66.35, 66.40. So this trade is losing, but given there's a lot of put credit spreads on the trading board this week. So I'm going to be adding longs, and I've got that one hedge on that'll come later in the week. So Anesh is saying he bought some leaps and Intel at the start of the year, down forever until NVIDIA and Northman got out. Oh, so yeah, he was hurting on Intel, and now so NVIDIA saved his trade. That's pretty cool. So lucky for you. But well, I think that's all we got for today, guys. I did hit record, so I will get this posted if you want to kind of check it out again later, or watch the replay. And again, we're going to be maybe changing the day and time of this meeting. So wherever you're following the calendar, if you're over on the website or in the meetup group, we'll update it there so you'll know. We're just thinking about maybe doing it a different day or time to let more people be able to come live, because not everyone can make it at noon. So that's all I got. You guys have a good one. Brian, thanks for joining.
Thanks.
And
y'all have a good day.
Thanks, guys.
Thanks, guys. We'll talk to you later. Bye.